Hello, everyone, and welcome to this short video on practical risk management and position sizing as a part of Pro AMT Club Live. This is Rishi Umrania here. You can reach me on Twitter at Pro AMT Raider. Now, this is a follow up video because after that analysis to action webinar, there were many queries on uploading the Excel sheet which I was using for position sizing. And that sheet had a calculation mistake in where the hit ratio is 50%. Because generally, what I use is based on my hit ratio. So, on a sample size of let's say 200 trades, if I analyze my results, then I find that 56% of time I am hitting my stop losses, and only 44% of times I am correct in my trades. Now, generally, we hear that you ask anyone what is their hit ratio, what is their accuracy. So they would say that the accuracy, we have a accuracy of 90%, somebody has an accuracy of 80%. Looks very good from outside when you hear about all that, because like I had a fancy that I should be accurate all the time, but then realized that accuracy is not what fetches profit, because you are accurate and making 10 points on a stop loss of 20 is like you are, if you get five consecutive losing trades, you will not be making even you will not be coming to break even after few trades. So even if the accuracy is less, but till your profit factor or the R multiple is great, where you can have consecutive losing trades, a streak of consecutive losing trades, like going into loss for one trade, two trade, three trades, four trades, and five trades even. But if your profit factor can recover all those losses in one or two trades, that will fetch you more profits over a period of time. Now, I'll just show you the sheet so that everyone can understand how to use it. So before like getting into this sheet, one needs to first find a system to trade and make observations that when they are entering a trade, what is, and suppose if they are keeping a stop loss of, let's say, 10 points, then is there a time when the market goes down 15 points and reverses back and hits their target? If that is happening, then better to keep a stop loss of 16 points, because if it's going to 15 points, let's say even 50% of the times you keep a stop loss of 10 points, the market goes down 15 points and then reverses back to your target. That means the stop loss is either just based on your emotions and bias, or maybe you are still not familiar with the system that you have devised. So the first thing, first and foremost, is to find the max stop loss with respect to your profit targets. Like at least your first profit target should be hitting. And it's not that the market might go 50 points down and come back to your profit target. That won't help, because then your profit factor will be very bad. So need to devise a workable system where suppose your profit target is 20 points, you keep a stop loss of 10 points, the market goes down 14 points, 15 points, and it's coming back and hitting your 20 point, then it's worth, because still you will get a 1 is to 1 risk reward ratio. And better is if you can make it like more than 1 is to 1, because then you can easily be wrong for two or three consecutive times. But if it's 1 is to 1, again what will happen is you will need to like have more winning trades than losing trades, because otherwise you won't ever reach the break even. So once you have found that, now the maximum loss you can incur on a trade can also be derived through a statistical approach, and you can look for the max adverse excursion. So which is like difficult terminology if you have not gone through it, but you don't require exactly those statistics for practically doing the risk management and position sizing, because what happens is most of the people leave out the studies because they find it difficult. So this is like, it's very simple, that you just go through your trade patterns, you go through how the market behaves around your entries, and just try to figure out when is it going beyond the stop loss that you are keeping. Because at times it happens that you think that you cannot keep a stop loss of more than 10 points, because the loss would be more, because you have traded like 50 lots, and you are calculating your loss on position size depending on the percentage loss you want to take on the capital, and based on that you are choosing a stop loss. That won't help, because your stop loss needs to be as per the system where the market won't go, because it's the point where you are ready to agree that you are wrong and you don't want to be in this trade. It is not a point where you want to exit because you are losing too much capital. We need to do it the other way, that you first find that point where you are willing to agree that you are wrong, and then based on that stop loss you decide the risk you want to take on the capital, and then get the max position size which you can trade based on that stop loss. So this sheet basically gives you that idea. And so before entering, these yellow cells are where you want to enter your entry price, the instrument, your total capital, the lot size. Based on the lot size, this will automatically calculate the value of that contract. Then the margin, which is exposure as well as the span margin, because when you are calculating just the span, it will be like taking a leverage. So better to calculate the entire margin, and this is specifically like intraday traders, day traders want to do all this, because they will be mostly trading future contracts. Those who trade equity, we'll go into that. I'll just show briefly, if somebody wants to trade equity, how to use this sheet. But first we'll talk about futures trading and how to use this. So this is 8% margin value, which is the span plus exposure margin. So your margin value would be 55,320 if you enter at 9,220, whether long or short. This is the risk you want to take. You can input any number of what risk you want to take. This is my stop loss points, the stop loss I want to put on that trade, and this is the profit factor. Now, how did I get this profit factor? Based on how I trade, based on my system of trading, I enter all in one go. So let's say I want to enter uh, at 9220 and exit maybe in three parts. So 50% I'm exiting at 16 points. So exit 1 and 2 both are at 9236. The rest of 50% I want to exit 25% at 9242, and want to exit the last 25% at 9245. Now, beyond this 9236, I have taken this conservatively based on the average exit I get. At times, this might go to I might get the 25% exit at 9,275 as well, and the last exit at 9,305 as well. So there are all probabilities that can happen, but I want to take the average, because I do not want to just because of 1 2 or like 10 or 15% profit targets. I do not want to screw the entire system. So if I keep the expectations on an average, then I would be like trading the ideal size. And by trading the ideal size, actually, I will be making better profits rather than getting a wrong profit factor and then losing more on losing trades. So, based on these calculations, my average entry price would be 9220 and my average exit price would be 9239.75, which gives me a profit of 19.75 for a stop loss of 8 points. So the profit factor becomes 2.46875. Now that profit factor we have entered here. So you can find your profit factor by putting your entry. Suppose somebody has a habit of averaging down. They want to keep a stop loss of 15, but they want to average down when it goes to 9215. So let's say they averaged in one part 9215 and 9215. So their average entry becomes 9217.5 and average exit is still the same, and the profit factor increases from the profit factor decreases, sorry, because what has happened is you are averaging the position, and then you are again after averaging the position you are trying to exit at better prices, but your stop loss has increased because you cannot have a 8-point stop loss. Then suppose if you had a 8-point stop loss, then your profit factor would increase. See, the moment your stop loss came to 8 points, your profit factor went to 2.7. So based on your system, you can find this out. But I would like suggest that find the most conservative figure. Do not try to aim high, because while making the system you would have already aimed high, and now like finally you have reached the stage where you can devise a system which can at least give you a certain profit, and that at least is the number we need to input here. So we'll go through what I generally do. So this is 9220 and 9220. So my average is 2.47, and let's consider that I will be right only 40% of times. So let's see, if I'm willing to take a 1% risk on capital, so the total amount of risk on 10 lakhs is 10,000. For 10,000 risk, this gives me a tradable size of 16.67 lots. Now 16.67 lots are not tradable, so I have rounded it off to a lower size, which is 16 lots. So if I am trading 16 lots, the capital applied would be 8,85,000. So suppose if I am taking 10,000 loss on this trade, and even if I go in loss for 10 consecutive times, still that much capital would be left that I can apply on that trade. So my size won't change even after 10 losing trades. So also need to be careful that this capital applied should not be should not exceed the capital available, as well as try to keep it like as much as possible 10% below the available capital, because then suppose you are taking a 1% risk, so try to keep it like 10% lower. If you are taking 2% risk, try to keep it 20% lower, because then you have a chance of taking 10 consecutive losing trades. And here in the sheet, if you are taking if the capital applied goes above your capital, this will automatically stop the calculation. Let's say I make a risk of 2%. The lot size tradable would be 33, but the capital applied would be much higher than available capital. So this will automatically show that it's not tradable. So whenever this more capital applied comes, either try to lower the risk, but that is dependent on what type of risk you want to take. And then you can press this execute and you will get this calculation. So over a 260 trade size, I would be making 24 lakh 53,465 on a capital of 10 lakhs with a hit ratio of 40%. So I would be right 40% of the times, because this is where the accuracy comes in. Suppose if you are right 50% of the time, the calculations would drastically change. The 24 has directly gone up to 60. But suppose if here your profit factor was less, suppose your profit factor was 2, that 0.47 difference in profit factor reduced your profits by 50% over 260 trades. At the same hit ratio, the profit factor, because see what happens is, when we are trading, we don't consider like 1 or 2 points here and there is like nothing for us. But for a 75 lot size, when you are taking multiple exits, and even a 2 point change would completely change your system over a period of, your profits would completely change over a period of time. Let's see an example that you had a hit ratio of 50 and your profit factor is, let's say, 2.47, which we have calculated here. Now suppose what happens if I'm getting my first exit at 3.5, 9235. So 50% exited, 25 plus 25. Then the second exit you are getting at 9240, and third you are getting at 9242. Now just 1 point difference in exit, the first 50% exit, and 2 points difference in the last exit. But see how the profit factor has changed. So it becomes 2.25. So earlier it was 2.47. When it was 2.47, your profit was 50 lakhs, because you are ending up with 60 lakhs. Now let's make it 2.25. Execute. 25% from the balance capital gone. What happened is just a difference of 2 points and 2 points again per lot, which doesn't look much when we are actually trading, but that difference causes, like, that's the power of compounding, that over a period of time, because the lot size is adequate on your capital size, what happens is, due to this size increasing over a period of time, you can see your buying power has increased to 76 lots by the time you reach 260 trades. Now few people might think that they do not want to trade this big, and also they would like their bread and butter to come out from this. So I would suggest that at least take a 20 trade sample size specifically for intraday traders, and then at the 20th trade, so this is the 20th trade, at the 20th trade you can withdraw the profit on capital, which is here 1,22,516. So 122,516 you have put as withdrawal, and your capital would be reset to 10 lakhs again on the next trade. So this much you have withdrawn. Again on 40th trade you can again withdraw the profits. So again, 1 lakh 12,000, 1 lakh 22,515. You are again withdrawing. So somebody wants to withdraw, they can just input the withdraw amount anywhere they like actually. But this is just what I'm suggesting, that do it after 20 trades. Somebody is taking a better trade, like they have a, suppose they have a stop loss of 15 points, but their target is like 60 points, which gives a profit factor of 4. If somebody is trading with that, then they would like get more profits, and they might want to like withdraw early, so they can do that as well. But just in case somebody wants to know what I do, then I'm just showing what I generally do. Also, many people like want to trade taking leverage and applying like 1 lakh capital, and they want to trade NF with a 1% risk and a 15 point stop loss, and they would have a profit factor of 1.5. They take a exit at 22 to 25 points. Not tradable. If you are taking a loss of 1%, you are taking 1% risk on capital, and if your stop loss is 15 and your profit factor is 1.5, your hit ratio is 50%, then it's not tradable. Now suppose you take a risk of 2%, then it's tradable. But your size comes to 1.78, so you can only trade one lot, so you can't take multiple entries and exit. Now suppose you take a risk of 3%, then the capital is more. So if somebody does reverse engineering, they can take a risk of 2.5% and start trading with this sort of capital. Like somebody wants to trade with 1 lakh, and they want to take a minimum 2.5% risk for a stop loss of 15, then possible. But then what will happen is you are essentially like applying more than the capital that you have, because your margin is 55, so you are taking a leverage as well. So suppose you take a few thousands leverage, here you make it 7%, and your leverage would go higher. So that way also you can calculate. Somebody wanting to trade like two lots to begin with can also do a calculation like this to manage it properly. So they come with a size where, with a capital size where they can trade two lots to begin with for a stop loss of 15 points. Let's see what is the capital that we require. So on a capital of 2,50,000, you can take a 1% risk, keep a stop loss of 15 points, and trade two lots easily. But then see what happens is, if your hit ratio is 50%, over a period of time, you will be making your balance capital would be 3,11,671. Everyone wants like 100% profits, but many people do not pay attention to all these position sizing rules, and they just take weird risks and size it as per their fancy. And then what happens is the account goes for a toss, and then again a search for holy grail begins. So here, ideal, if somebody had a stop loss of 15 points and had a target of like 2, would become something viable, and they would be able to like see that 100% that they want to see in their account. Now suppose anybody wants to like change anything, you can change in these yellow cells. First find your average entry and exit points, put that profit factor here, put your stop loss as well as risk on capital that you want to trade, that also you can put in here, and then calculate. If somebody is trading let's say stock, then all that they have to do is put the number of shares instead of lot size, put the number of shares as one. Let's say somebody wants to trade a xyz stock which is priced at 200, and the value is 200, the margin is 100% because you want to invest in it. So you will have to, for each share you want to buy, you will have to pay 200 rupees. And if you want to take a risk on capital as 1%, and you have let's say you want to keep a stop loss of 10 points on that, and you are expecting a 20-point profit, then 250 shares you can trade, because here you don't have to, you are not trading regularly, you want to invest. So only the first thing you want to think about, the second lines you don't have to see. In case you want to do day trading every day on a stock, then you can see that also. So there you get calculations every time. So here I have calculated like in 50%, you are wrong the first time, wrong the second time, and right the third time, and fourth time again wrong. So I've calculated like wrong first, because the chances of losing are higher, and we want to be safe that first time if we lose, we should like be able to trade next time. So somebody using stock can use it this way. And there are many things you can like play around. You can take when you are taking leverage, your risk automatically like increases. So you, if you are taking, let's say on a future xyz future, stock future, your entry price is 200, uh lot size is, let's say, 3000, and you are paying a margin of 8%. Your risk, you are taking a leverage, then increase this capital. If you are taking 2x leverage, then make this 5 lakhs. And when you make it 5 lakhs, automatically you are taking 1% risk on 5 lakhs becomes 2% risk on your existing capital, which is 2 lakh 50,000. So there you can see what size you can trade. Nothing. And we hear of like people trading stocks with 1 lakh capital, and they do a MIS, and then they complain that the market is bad and they are losing. So here your effective risk goes to 12%, because the 6% is on 5 lakhs. Your available capital was 2 lakh 50,000. You took a leverage 2x, and that means your risk has multiplied. So basically, that much risk you are taking to trade one lot. Now, suppose somebody has, let's go back to the original calculation, that somebody has 2.5 lakhs and they want to trade the same stock, but their stop loss is just 3 points, and they want to take a risk of 1%. Still not tradable. Now, let's say they take a risk of 2%, not possible. Take a risk of 3%, not possible. Take a risk of 4%, possible. So the minimum risk you want to take on capital is 4%, even if you have a stop loss of 3 points. And if you keep doing this with a profit factor of 2 on a consecutive basis, then this is what you will end up with. And that's how, like, the profits do not go higher because your lot size stays smaller. So what I generally like prefer is to get adequate sizing where my capital applied, like if here in case I'm getting like let's say this 1.74, I don't want to trade one lot instead of 1.75. So what I want to do is increase the capital a bit. If I'm getting this, increase the capital a bit so that I can trade two lots and get multiple exits. So many different ways to do it, but still I would like suggest that the simplest way, put your capital here, put all the other input parameters, and try to check where you stand. So I'll be uploading this sheet there, and anyone can use it. And also, if somebody has, they can choose the hit ratio here. Somebody has a hit ratio of 80. So 80% of the times they are right, and only 20% of the time they lose. They can use the hit ratio of 80, and the entire calculation would change. So based on your hit ratio, you can choose. Somebody has a hit ratio of 100. I don't want to show what happens then. So you can check it yourself, because there might be few people who are never wrong and are right 100% of times. So I have kept that option as well. They can put this, select this 100% option and press execute, like we uh, pressed it in all other hit ratios. And after doing anything, so when you are changing anything, make sure that you press execute so that the calculations are executed. And at 100 you can try to execute and see, and there is a surprise waiting for you. I think that's all what I wanted to discuss. And if anyone has any suggestions to be added, or if anyone thinks that anything else is required in this, then do post in the comment section. And I'll try my best if I can incorporate that, because there are few limitations to this. Because if I'm like I'm trying to make it like usable by everyone. So suppose if somebody wanted like hit ratio of 42%, it will be like doing it multiple, then I have to do like 99 times, I have to do all the calculations. So I just kept it like in the multiples of 10. But still, if somebody thinks that something is required and is missing, then they can just post it in the comment section, and I will try to program it. So thanks for watching, and have a profitable trading year ahead.